So, I mean, basically, like, if I was to summarize, the issues around all of this is that there is regulations which may or may not, probably had some good intentions trying to create better price transparency and better pricing for retail. The problem is that regulators are always two steps behind the market, and so they implement regulations which can end up being harmful to investors. A question I had for both of you, and this is more because I personally don't have the answer to this. How would this relate? This paying for order flow, is this something that we could possibly see with centralized U.S. crypto exchanges like on Coinbase and Kraken, or is it just too nascent and that's something that we wouldn't know?
It's a total risk in my opinion. I think. I would like to believe that the market focuses on the best solution for everybody. And I think that if you have regulators that take steps to protect investors but don't overly engineer stuff, right? Because the U.S. equities market really is a byproduct. If you look at U.S. treasuries, if you look at foreign exchange markets, those are the two biggest markets in the world, and they actually operate pretty efficiently without a lot of sort of the centralized reporting and requirements that are imposed on the U.S. equities market. So if crypto is allowed to, let's say, for example, there's no regulatory capture that says you must have this national best bid and offer and you must report all things properly. What would end up happening, right, is that people would deal on exchanges. And if they had the choice between an exchange that did payment for order flow, an exchange that did not do payment for order flow, or for that matter, an over-the-counter option with somebody that was a bilateral trading relationship, they'd look at all those things and like, all right, where do I get the best execution? And they'd deal on the payment for order flow site, and they would be like, actually, you know what? I might save myself a little bit on fees, but my total cost of dealing, as measured by a number of things like, post-trade market impact, order slippage, all that sort of stuff, is actually pretty terrible. Like, it's absolute garbage. There must be somebody trading against me on the other end of that. And then they'd look at a general exchange, you're like, it's slightly better. I pay some fees, but, at the end, it's run reasonably fairly. And I don't think that there's any one organization that's, using some informational advantage on the back end to trade against my positions and drive them against me. So that would end up being a better solution, so long as people have the ability to trade on either one. And then obviously they'd look at OTC and they'd be like, all right, well, that actually, if I have access to that and I've got credit lines and something like that, it's way cheaper. The spreads are tighter. And generally speaking, I know who I'm trading with. And so I know that they're not doing anything against me because I can always just hold them accountable. Mm-hmm. All of these things, like if you actually are in a market environment and the regulator's not saying, oh, well, actually, this high frequency trading firm paid us a lot of money and donated a bunch, so we're actually going to shift the regulatory side such that it favors this exchange with payment for order flow. People will end up looking at it eventually and they'll say to themselves, well, it's not really that great of an option. And those guys will just die off because it's a shitty market practice. So I'm hoping that that's the way that the crypto market goes. But it is a fear of mine that the market devolves into a lot of these centralized exchanges, realizing that an easy way for them to make money is to make sort of these backroom deals with high-frequency market makers that do shitty stuff.
What do you think one of the nice things is that currently all those exchanges are very accessible? So you can actually get a pretty good idea of what mid is. That's actually a lot harder in like other securities to do. Securities markets up front are not open to everyone. And then the issue is like, how do you know you're getting best execution? Like, okay, you've got the NBBO, but as you said, that could be lagged, could be wrong. And then where are they getting their information from that makes them be able to monetize it? Well, other exchanges which we don't have access to, type of thing. So I think it's one of the nice things is that if something like that did happen in crypto, you'd be able to spot it, I think, pretty quickly.
Yeah. I think one of the biggest indicators, just from like a technical level, that everyone should watch for is right now. I think one of the beautiful things about the crypto market is that the majority of price discovery happens on Amazon Web Services. And people could, no, I'm dead serious.
Yeah, it's amazing.
Because the centralized exchanges, the way that they work is there's a data center somewhere in New Jersey or London or, Hong Kong or Singapore. And the exchange has servers and they rent out places next to everybody. So the barrier to entry to get access is like $1 million a year to rent out a server next to these places. Then they have like super fast copper wire connecting them so that they can like communicate sub-microseconds. So if you're not in that club, if you're not part of the $1 million a year plus club where you pay for that infrastructure, then there's no way that you have an edge over short time scales. Just fuck you, right? You're done. So if you have all of these exchanges right now have said, we want to have a fair ecosystem. So let's do this on Amazon Web Services. Now, in some ways, that's terrible because a traditional market maker is like, oh man, that's like 10 milliseconds latency. That's so slow. But the playing field is level. Anyone can come in and subscribe to the API, trade on it, and the playing field's level. Citadel Securities doesn't have any extra advantage. They could be best friends with Jeff Bezos. There's no way they're getting better latency on Amazon Web Services because in some ways it's randomized and you have to go through several layers of virtualization to get to where you need to go. So
that's one of the questions I had. So I might be over engineering it, but do we know that whether Amazon Web Services has certain data centers throughout the United States, and could someone like a Citadel set up like pods next to all of those Amazon Web Service data centers so that they could still effectively have like an edge?
Totally, but your limit, you're never going to be able to physically pin right next to the server that's running the matching engine, because that's what it is, right? Coinbase, Kraken are running a matching engine. The chances of you actually getting the PC that's right next to that is very, very small. You might get one in the neighborhood, and you can ping that to find out where, change your PC each time within Amazon and get closer. Probably very expensive to keep doing that as well, and time inefficient.
Yeah.
Probably be better off just trading. But you can try and hone in on where something is and look at your latencies to reduce them. But what's that going to get you? You're never going to be like directly next to the box. And if you are, that's by random chance. Won't be there.
And even if, let's say, for example, even if you manage to be randomly assigned on the server right next to it, best way to think about it is there's several layers of virtualization on those servers that add extra latency. Because when you rent a server from Amazon Web Services, they create what's called virtual servers. You're typically not running bare metal on that box. So because of that, and there are going to be network people who are like, Carlos, you have no idea what you're talking about, and there are going to be people on the other end be like, what the fuck are you talking about? I'm trying to keep this like middle of the road, but effectively, because of the way they run it, even if you randomly get lucky next to and you get placed next to it, you're still not going to be sub-microsecond back and forth because there's several software layers in between you and their server. So, it's like I said, you could be best friends with Jeff Bezos, and even if you're super lucky or you try a bunch of random things, like there's a floor, there's a limit to what you can actually do in terms of reducing your latency. So it's not an edge for anybody to have better latency.
At least I've not yet heard of them offering services to pay to have. So Kraken would also have to agree, for instance, to pay to physically locate on a hard server that is always theirs all the time, which maybe they have. But then, I've not heard them offering something where you can, I want to be right next to that specific machine.
Yeah.
And as Carl said, there's other layers that happen when they broadcast.
And to be
fair,
fair, I think, for example, we've spoken with the guys over at Kraken, and the guys at Kraken say they are not going to do that as a matter of principle because they prefer to have a more democratic access to market data, which I think that's a great feature of the market. You might talk to some traditional HFT guys who are like, I don't know how you can even trade and make money if you don't have this special advantage. And the answer is well, be better.
So I know places like Jump, for example. They're super big HFT, and they're pretty big in the crypto space. I know, like on Solana, they were in close partnership with FTX, for example. How do these guys even plan to make money? Because it sounds like it's just like the latency is so long that any speed edge that you have just gets totally decayed by the infrastructure of these exchanges.
But the latency is the same for everyone. So, like, you can still make your computers pretty fast. Like, don't get me wrong, you're talking like microseconds to do something. And then there's, well, how much do people want to pay to get down to that level? But then all I'm saying is the initial latency is pretty much fixed. You can't physically get closer to like NY4, which is a hub in New York. Who owns that NASDAQ? I forget. It doesn't matter.
Okay.
But a trading hub, and I could be based in pick anywhere, like downtown
your
Manhattan.
villa in St. Bart's. Oh, sorry.
Yeah, I could only afford to live in Manhattan, and that's where I then connect to that box, right? I could then try and get closer and closer to it, but to reduce the latency. But there's an incremental cost every time you do it. Until, as Carlos said at the start, you're right next to the box, co-load in with the server, and you're in. And it costs very expensive to do so. At least with crypto, that initial barrier to entry has kind of been eradicated for now. And then it's a matter of, well, okay, having faster machinery means you'll be able to get trades before someone else. But then that's a question of, everyone has that constraint. That's a software problem as opposed to it being a hardware problem.
Do you think of this reduces it? Like, what's the so? I know I'm kind of digging into it. I think it's actually fascinating. I know it touches on a lot about what you guys do. So, because of that threshold that's created, that infrastructure kind of it creates this like a little bit like a higher latency. The costs for entrance into the market, maybe does it go from like tens of millions of dollars in capitalization to be able to compete down to like just millions of dollars, or like what's the delta you feel like?
Yeah, I'd say it takes it down by an order of magnitude. If you think about what it costs to do a high frequency trading firm in tradFi, you need to have capital to trade, in the tens of millions. You need to have infrastructure, meaning like rent out physical, locations across a number of different data centers across the world, each of which costs millions of dollars.
And that's exactly it. It's rent. You're paying like rent to someone to have a space, like it is rent.
And then to top it all off, you need to have a very specific type of engineer, right? You can't just get a normal software engineer. You need like an engineer that knows networks. We're talking like understands the way that data flows, like, material sciences engineers, people that understand like microwave connectivity. You need people that understand extremely low level, programming languages. You need people that understand what are called FPGAs, which we talked about last time, or like chips that are specific to just doing that, right? The software component, the data analysis bit is really kind of like, whatever. But there's a very specific skill set and a very small number of people in the world that do all of those things, and that's a huge outlay of capital in order to get that. In crypto, you need a fairly decent DevOps guy to set you up on Amazon Web Services in a meaningful way. You need to be able to store your data in a proper way. You still need to have performant code, as Matt said. So like the infrastructure is kind of like a level playing field. But then once you get the data in, you still need to process that data and do stuff. So you typically probably wouldn't want to do that in just like vanilla Python. You'd want to have some sort of, performance enhanced or lower level programming language, or at a minimum Python or C++ or something along those lines to process that quickly, because that can matter. But really it's more of a software cloud engineering problem, more so than needing to outlay all of that physical capital and renting of space and equipment. So it really does change the game for crypto.
Oh, interesting. That's fascinating, guys. Thanks for explaining.